Hi, I'm Aoife Devitt, and welcome to this week's Markets Happy Hour podcast. I am delighted to be joined by a fellow CIO and market commentator, Pete Drewienkiewicz from Gallagher Benefit Services, formerly known as Redington in the UK. Welcome, Pete. Great to see you here.
Morning, Ethan. Lovely to see you. Very good.
Well, I have been an avid follower of your thoughts from the Loft, as I'm sure many in our industry are. So we will try to capture some of those thoughts from the Loft in this podcast, and looking forward to cycling through our usual topics. As usual, I'll kick off with the slides, and I call this a chill descends. And both of us are, I think, keenly aware that a chill has descended in the UK at least. Whether it leads to train trouble or bad hotel lighting, it is is a factor for both of us. But there has been a bit of a chill descending in markets too. So there is a little bit of a double meaning in that. As usual, we'll cycle through inflation, interest rates, equity markets, geopolitics, and touch on other asset classes if we have time. And some of the sub conversations today, the subtexts, looking a little bit at inflation, look at the role that food plays in that, as clearly food, it is that the holiday season coming up, everybody will have food on their minds, and the affordability of that food, whether it's affected by tariffs or not in the US, will be a factor. We're going to look at the interest rate trajectory in different global markets and ask what the plateau is likely to be. As we are all focused on equity markets and the AI story, we'll ask whether AI is scrambling some of the signals in there. And Pete has some great slides from his last week's newsletter where we'll touch on valuations. And then finally, have a quick note on total portfolio return approach, since that has been in the headlines, recently analysed by the Financial Times. And we'll take a look and see, is this all it's cracked up to be, or is it just a buzz, as was stated in the Financial Times? So a little bit about portfolio implications when we get there. Here is Pete, a great resume here. We'll let you read that at your own leisure, but fantastic experience across all asset classes. So Pete, we'll first kick off with inflation. So I've been showing for a few weeks charts showing in the US inflation getting closer to the 3% mark. We have had a little bit of relief in the UK in the fact that it's now 3.6% and not 3.8%. So still a very much higher than some of the global norm. And we've had some news this week that President Trump is likely to roll back some tariffs on some staples, if you consider coffee, tomatoes, etc., a staple in the US in terms of getting some of that affordability back into the average food basket. But I'd love to get your take on where we are heading in terms of this direction of travel. We see that energy has been subdued, food has been the issue. What's your take on whether we are in fact resting at this higher level, or what the trajectory is likely to be?
Yeah, well, I think sticky is the word that everybody's been using, and I think that's the right word. And I think the big issue really has been in services, where we obviously saw that big, the big inflation spike up coming out of COVID that we all know about. But really the hangover from that, I think, has been in continued wage inflation, which has been bleeding into the service sector, and you can see on this chart the services, is really still the problem. So yeah, I think we're stuck in a slightly sticky inflation world. Interestingly, expectations don't seem to have moved up too much, but we'll have to see if that does change in the few coming months.
Absolutely. And what I showed a chart last week, the extraordinary chart showing that it depended on your political affiliation almost in the US, whether you believed that inflation was likely to head down or not.
Yeah, I've seen that one. It's amazing, isn't it? Amazing how you can just have such different views, different sides of the aisle.
Exactly. And I mean, the interesting point also here is around inflation and earnings calls. And this was just a classic Bloomberg search feature whereby we see how often it's been mentioned. Although there has been just a little bit of development on that, given the black hole in economic data in the US, a suggestion that we are now returning to focus on inflation as a concern. So I think this is a very kind of sporadic thing in terms of concern. It has not, I think, been beaten back yet necessarily.
Yeah, 100% agreed.
And moving to interest rates, so clearly inflation and employment, if we look at this, say, start with the US, the two focal points of the Fed. And we've been very focused on this in terms of the on again, off again pressure on the Fed to lower rates. We've just had more rhetoric from the president around firing of the chairman and him not knowing what he's doing, etc. And I don't think that helps matters in terms of injecting certainty into this trajectory. I think it probably spooks markets somewhat if there is a sense that there would be perhaps a lack of independence there. This is suggesting here that the plateau for different central banks is likely to be different, in that we could see the Bank of England bank rate likely to perhaps be the higher plateau, given the inflation we see in the UK resting at 3.6% today. The Fed likely to be somewhat in the middle, and the ECB confidently able to reduce rates given the perhaps lack of economic growth, the lack of overheating clear
Mm,
in the Eurozone. So
yeah,
you, I know, follow rates closely and the fixed income market.
yeah.
Does this make sense to you? Does this look about right to you?
I mean, I think it's interesting because, from my perspective, I see the UK economy as being noticeably weaker than the US. From my perspective, and I think that although you're absolutely right to identify that sort of lingering concern of inflation, but I think that the UK is struggling to grow, and I think rates will need to come a little bit lower. So I'm always surprised that markets have been happy to sort of peg this UK rate plateau so much higher than the US. I think probably it's likely to end up more in line with the US. And then I think the risk for the US is, if Trump finds someone who will cut rates for him, I don't think that's a complete panacea, because I think that sort of political overshadow is likely to potentially feed into steeper curve and potentially higher rates further out along the curve. So it might not be such a complete slam dunk. But as you say, the ECB seems to be sitting pretty. I mean, no, growth concerns, sure, but from an inflation perspective, they've had it much easier than the other central banks.
And it's interesting. I mean, this idea of Fed independence that has kind of come and gone, I suppose, and come up again. Do you think that is perhaps an overblown concern, that there it seems that as we get closer, or in the twilight, another guest has described as the twilight of Chairman Powell's tenure, that whether he gets fired or not, it's essentially less of an issue as we are in the last few months. Do you think that the idea of federal bank independence has perhaps been overblown as a concern?
I think it's probably been a little bit overblown. I mean, I think it is an issue for markets, but I think that ultimately President Trump has demonstrated. Ultimately, I think that he does want to have capable people in important roles, and I think it's likely that even if you find someone who's a little bit more dovish, maybe than the current FOMC would be. Nonetheless, I think it's very likely to find someone competent who's going to give markets confidence, because it's going to be an issue for markets otherwise, as you say.
And I think just before we move off this, one of the issues that has come up a lot is cash, and whether cash is a good place to be invested right now within a portfolio. One of the issues with cash, of course, is its potential and real fact that it will get eroded by inflation. So when we have a resting interest rate that's whether it's high or low, and if inflation is somewhat persistent, I suppose this will then call into question whether cash is a drag or is a safe place to go. And a pervading narrative right now seems to be that everything else is expensive. So, do you have a view on cash at this very moment?
I mean, I have a long-standing view on cash, which is, which I think about, which is that I think cash is a pretty terrible asset, unless you are really valuing liquidity to the point that you want to be able to deploy it, at a moment's notice. And that's clearly where it is the most important asset, and that's where the phrase "cash is king" is certainly true. But I think generally speaking, if you've got some type of view or some type of medium-term objective, there's usually a better asset to express that view. Whether it's short-dated credit, ABS, or just bonds in general. You can usually create a better outcome by holding an asset that isn't cash, in my opinion. And this thing has been written pretty heavily on the topic.
And I do agree that we tend to often underestimate the effect of inflation on our returns, given that our own personal inflation can be a lot higher than that average inflation level that we showed earlier. And moving now to equity markets. So clearly, we're recording this on Thursday morning. We had Nvidia's results last night. What were we looking at in the backdrop? There was a distinct chill in the air when it came to markets, and their somewhat torrid recent run, at least in the last week. We did have this AI bubble talk. It became commonplace. It had gone from a few kind of outlier short sellers and contrarians to being the mainstay of financial media. And I think the other interesting part is that the crypto trade had been so, in a way, kind of a bellwether of the demand for tech, even they're not completely related, but there is definitely overlap in holdings. Crypto has been quite under some pressure for a few weeks. I suppose the only
Yeah.
upside, we had this upset, the first interruption to big tech outperformance since May. We've had this a soaring profit announcement by Nvidia, which may have soothed some of the jitters. And
Yeah.
clearly, as we see, all roads lead to Nvidia, not only in those complex interconnected webs that people like to draw, but also
Yeah.
when it comes to market sentiment. So we've got a lot of a couple of things to say about U.S. markets and other markets in this piece. But I'd love to hear, what you're thinking about the current sort of set of chills running through markets and whether it's justified.
Yeah, I mean, look, I think there's been a big run up in share prices, some of which is justified, but I think the stat that jumps out at me is, how strong price momentum has been in some of these stocks, and particularly unprofitable and even no revenue stocks has been very very pronounced. And so I think we are at a point where the market is taking stock a little bit. AI is kind of everything. I read a fantastic investor letter this morning that was saying, from a perspective of like the investing universe right now, AI is the sun, and everything else is kind of going round it in orbit, at different distances from the sun. And the closer you are to AI, the better your share price performance has been so far this year. So it's definitely been driving, almost everything.
Absolutely, and we have some slides, I think, some of which have been kindly taken from your letter, and others that have been showing up. And I think this is the point here: is that this has been showing up in earnings. If we were to do that word count in terms of how many times AI is mentioned, it's certainly been mentioned everywhere. And there has been discussions of productivity, with 47% of earnings calls discussing productivity. We've also seen massive signs of adoption across the spectrum. So not just in those top 7, top 10, there does seem to be that filtering through. I thought it was interesting, though, just to speak about this chart here. Everyone speaks about K-shaped recoveries, and I think K-shaped to me just indicates divergence. And some of the divergence here, where we're seeing that it has actually been the infrastructure stocks that have really soared. That has, maybe
Mm.
it's natural, it's early cycle, it's where the capex has gone. But AI enabled revenues have done decently, but productivity has had no potential impact on a stock's performance. Because maybe that's just a given that every single stock will somehow benefit from productivity. So I thought this was interesting that it's already investors have been discriminating.
Yeah, I mean, I think the AI story is clearly quite a bit more nuanced than that when you get below the surface, and as you say, it gets into different layers. Where's the infrastructure? Where's the power going to come from? Are the power estimates right? Is there going to be enough power? Obviously, there's been stories about communities being quite disgruntled by having huge drains of power for these data centers that are being built locally. So, yeah, there's an awful lot going on here. But I think what you have to think about from this productivity perspective is thinking about, if you go down the kind of list of sectors, in the main market indices, and you think, how big an impact is AI going to have here? I think you can certainly quite quickly find more than a handful where I don't see a massive productivity case for AI. It's not to say there aren't a lot where there is a big productivity case for AI, but I think equally, there's a big chunk of the economy that maybe we're not paying quite as much attention to, where there's a much more challenging case for productivity gains.
Absolutely. And I think the other point, what we're seeing here, is also even before, we're certainly reaching a sort of higher level of volatility in markets. And we've spoken a lot, I know you have before, about the concentration in markets by these top 7, top 10. That has still not subsided. That's perhaps why AI is the sun, because we're also seeing this concentration. And whereby we're also there seems to be now an uptick in volatility. We had this very calm complacency, not only in equity markets but also in fixed income. And we were looking at the VIX and the move here. Both of them have ticked upwards recently. I've got a couple of things to say on this to ask you, actually. Why do you think the move has been so subdued? Why do you think fixed income has been so subdued and calm, even though we've had these jitters come back into equity markets?
Yeah, I think to some extent, uh, you know, bond markets have been waiting for a number of resolutions, right? We've been waiting for the budget resolution here in the UK. We were waiting for, the governmental shutdown in the US to sort of find a resolution as well. So I think to some extent, bond markets were sort of treading water for a little while those dynamics worked their way through. And now, now obviously a couple of weeks' time, we're gonna see the resolution of that, particularly in the UK. But obviously, we've seen the end of the shutdown, at least for now, in the US, which has opened the government up until the end of January. But we'll have to see whether they're able to come to an agreement that puts that on a better long-term footing.
Exactly. It's been interesting because I think some of these numbers we're seeing, that the larger they get, the larger these market caps get, the larger the moves get. And I think clearly then the larger we see in terms of the just the actual impact of, say, an US overweight in a portfolio can be when you have such concentrated names there. But the other thing that I thought was really interesting about some of the work you did this week was digging into some of the valuations. And one of the thesis that's out there, we've heard about even Larry Fink saying to be overweight in the US. We've also then had a lot of strategists saying, well, this is the time now to diversify away from the US and prop up that global exposure. However, there are some things that I think are less clear from a typical global diversification argument. One is that EM is very strongly locked in to tech, and certainly China and Taiwan, and that is very much going to march in sync. And we saw Asian markets rally just in the aftermath of the Nvidia news. So clearly quite a bit of correlation there. I thought it was quite interesting. Maybe if you can talk about these charts since they were in your slides last week, suggesting that maybe the US is not such an outlier when it comes to valuations after all.
Yeah, I think there's a narrative about US exceptionalism, and I think the US is exceptional in many ways. But I think it's important for people to realize that if you look certainly over the last 5 years, which is that the chart on the right, that the US has not really been an outlier at all in terms of actual delivered earnings growth. So yes, those handful of very large companies have continued to deliver, and they look, and let's be clear, the concentration. I don't see a massive catalyst for it to reverse hard anytime soon. These are huge global companies. Yes, they're US headquartered, but they are really, truly, global behemoths. And they have kept on delivering. But if you look at the broader US market, on this slide, you can see that it's been outpaced, way outpaced by India. It's been outpaced by Japan. Actually, even the Eurozone, which people sort of talk about as being, in something of a sort of productivity and growth slump, has actually nearly delivered the same level of earnings growth. So what we're seeing now is actually a much more nuanced story in terms of where we think there's going to be value creation for different regions and different sectors moving forward.
This is really fascinating because I think it flies in the face of so much of the narrative around the US, and the fact that it alone can secure large margins. It alone has the pricing power. It alone has the consumer power. And equally that it's lack of excessive regulation, it's innovative economy, that this is driving upside. What I read into that is maybe I would question the idea of other countries playing catch up. But I suppose we do still have to question, why is it that the US market cap has screamed ahead so much when other market caps have not kept pace? It seems that maybe people have got divorced from fundamentals.
Well, I think you've got to remember that their profit margins are still better in the US and have managed to hold in at levels, and they've really resisted mean reversion that many analysts would expect to see coming in over this kind of time period. So profit margins have stayed very, very impressive in the US, and I think that has been more of a driver than the actual level of earnings growth. If you see, it's the resilience in those profit margins. But of course, you have to think that those profit margins are ultimately baked in to price to earnings ratios, and so when you see analysis like I saw in and I'm sure you saw this one in Bloomberg, where they said if profit margins remain elevated, maybe the stock market isn't that expensive, and they divided price to earnings by earnings margin, which is basically a nonsense. You're dividing something by profit squared, which is clearly a nonsensical formula. And so you're seeing this justification of high price to earnings numbers, but ultimately, like, the profit margin is in that earnings number. People need to remember that, and we are already assuming to some extent that those profit margins will continue and remain elevated when we when we buy a given stock or index on its PE today.
And I think, if anything, if we do look at some of these short sellers, I think this is the important part of the stage we're at in the market today, is we are starting to question some of these narratives. I think we are starting to even question the veracity of some of those earnings, certainly the stability of some of the margins, the knowledge that there will be first mover advantage, but that can quickly get eroded as consumers discriminate and enterprises discriminate as to what, say, AI model they ultimately use. So I think this kind of pushback is very robust. And the other very stimulating chart that you had in your last newsletter was this around NASDAQ no revenues, and just how this may in other terms be a dash for trash, or I'm not necessarily saying a no revenue company is trash, but there certainly has been an outperformance in the most speculative, perhaps, side of the market. And you tied this to the struggle that active managers have had. And I'll just present this other chart that I had earlier. Yes, managers have struggled and investors have spoken in terms of their desire to prefer indices over traditional active funds. But just getting back to this, I mean, is this typical in markets that we see these no revenue companies doing so well because of perhaps the hype, the froth? Or do you think this is an anomaly that will also revert to a mean?
Well, I think that if you wanted to make the case that that we are in a very expensive market, or potentially even in a bubble to utter the word, then I think that this would be part of your case. You would make the argument that this looks like something of a kind of last frothy blow off, where you see companies with no revenue doing very well. It is astonishing. I mean, I think the one that really stands out at me is this gap, as you say, Ethan, between the left-hand bar, the NASDAQ no revenues up 34%, NASDAQ revenue producing shares only up 11%. So that 23% gap is clearly very, very meaningful. And the reason that's difficult for active managers is, even your growthiest growth manager is going to typically be looking for some revenue. You're probably looking for some earnings, frankly, but they're looking for growth in the revenues, and they're looking for growth in the earnings. And I'm sure they're going to find a few gems that are unprofitable or even pre-revenue, where they can see fantastic potential. But it'd be very unlikely for managers to pack a portfolio full of those more speculative stocks. And so, that move that we've seen through Q2 and Q3, that has really been where this has really gained momentum. Deliberate choice of words, as it's been a very momentum-led market, has been very difficult for many active managers.
And it's interesting, venture capital comes and goes as an asset allocation choice within portfolios, but you could argue that some of this is essentially akin to venture capital style investing, given the pre-revenue status of some of these companies. So definitely an interesting piece of analysis. I know we're in the interest of time, I'm going to rattle through two very quick topics. One is private credit. This is basically showing the outperformance of US big banks. They're outperforming some of the regional banks. We know that they have had their issues on a kind of a case-by-case basis. Less of a regional bank kind of landscape outside the US. And then also some of the private credit, the business development companies have also struggled. We've seen some high profile names in the news reverse course just recently because of these funds trading at a discount. We know they've had a fairly torrid run, the diversified companies. And what does that tell you? I mean, you as an allocator will look at private credit for your clients. Do you think this is a time to be even more selective?
Look, I think it is a time to be selective, but I think that this is slightly overblown. I mean, I think that there's been a huge amount of private credit headlines, and I'm not surprised by that, because there's rates went so much higher. Those loans are all floating rate. Companies to some extent were going to struggle with those, with paying 12% where they'd anticipated they were going to be paying 7 or 8. So it's not surprising that there's been some credit issues. But I do think that that's been overblown. And when you look at this red line, where you can see essentially what's going on here is that the banks have performed very well, and then those listed private credit entities, BDCs, have performed very poorly. I think that is really largely a narrative that has been driving those down, although there are certainly some names in that BDC index that are not very institutional names, who are, I would say, struggling with worse quality portfolios than we would typically see on an institutional basis. So I think, high quality, well-originated private credit portfolios that are well diversified, we're not seeing a huge amount of issues, but we do expect to continue to see some idiosyncratic credit shocks.
And it's interesting, and this kind of leads on to our last topic, where we'll just have a quick comment on total portfolio approach. It's really just how this is a sliding scale here. So we have traditional credit, fixed income. We talked about that being calm. We talked about some of perhaps the cockroaches or some of the trouble being perhaps brushed into the private credit arena. We know that investors are voting with their feet. At a live podcast I did in Chicago a few weeks ago, private credit expert commented on the erosion of fees in things like direct lending. Yeah. We also heard about the lack of due diligence being done in some of these deals, not that there not being perhaps the margin or the spread to justify it. And then we know there's a lot of crowding. So there's definitely been a mixed picture. And then previously showing here how some public equities are starting to look very like venture capital. It perhaps is breaking down some of those traditional asset class barriers, which leads me to the idea of asset allocation. Are we getting to a point of being kind of out with the old? This shows that still it's a stocks still trump bonds when it comes to allocations over the next few years in terms of return. And stocks still dominate most institutional portfolios. We know that. But increasingly, we're having this new buzzword, which I loved how Toby Nangle, an excellent deep dive in the Financial Times,
that's very
buzzy
good.
but fuzzy new phenomenon. And I think he really captures it. Is this a way of thinking? Is it a philosophy? Is it a kind of a new school? Or have we always had essentially a total portfolio approach in one way? But now we see whole governance structures being rethought according to that. CalPERS being a great example. I'd love to hear your just in the final few minutes here. Do you think this is a new regime, a regime change, or a little bit of more of the same, or somewhere in between?
Look, I mean, I had a colleague call me yesterday. He said, "Isn't this what we've always been doing?" He was like, "I don't get this whole article because it feels like this is what we've been doing." And I said, "Yeah, it is. It is. This is the way we do things. This is the way Redington, now Gallagher, approaches things. We think that a focus on risk budgets, a focus on objectives, what you're trying to achieve through time makes much more sense than sort of being, maybe somewhat slavishly." Locked into a particular benchmark where you might have to hold some category of assets regardless of their attractiveness, which is the big thing that I think people feel is a weakness of SAA. Now, that said, I don't think this is a panacea at all. And I think Toby really pulled this apart beautifully. And I suspect we'll be talking, myself and him, about this at our investment conference on the 4th of December as well, is that when you look into the numbers, this implication that there's significant alpha coming from people using total portfolio approach. In fact, what's really going on is that they are increasingly likely to be benchmarked to their objective return or to a kind of cash plus type return. So some of that alpha, we can have a debate about how much, some of that alpha that's coming through is really just the outperformance of equity markets over what their expected returns would have been, over what people would have expected their contribution to the outcome to be. So you expected stocks to deliver maybe cash plus 5. They've handily outpaced that, and hooray! You look like you've delivered all this alpha when you break it down that way. So I think we need to be careful in how we measure success here. I do think it's a good way of managing money. It's not clear to me that maybe it's it's kind of instant genius in a can or anything like that.
Excellent. Well, a great place to end this. I think it is. We do need to pull it apart. We do need to, in the words of Roy Crow, who we both work with, think like owners. And an owner would think holistically across an entire portfolio. An owner would not be pigeonholed into thinking just how one asset class thinks. And getting back to your discussion on cash and it perhaps not being the panacea, I think we do need to think about how our asset classes are evolving in the current landscape. Well, Pete, it's been an absolute pleasure to bring Thoughts from the Loft live here. A privilege to thank you for your service to all of us, for making us all think. And thank you for sharing your insights here.
Not at all. Thanks very much, Ethan. Real pleasure.
Thank you, everyone.